to our webinar, and I want to thank everybody for joining us here today. My name is Michael DePaulis, and I'm a Senior Vice President at Weatherby Healthcare. If any of you are unfamiliar with Weatherby, we're a locum tenens staffing agency that places physicians in jobs all across the country. Now, I'm assuming many of you are joining us as are either locums or interested in learning more about locums and how you can save some money on your taxes, which is really the purpose of the webinar today. Before we get to our guest speaker, I just want to kind of go over a couple of housekeeping issues. Each of you should have a Q&A box that you can look at, and if you have any questions, please add them there throughout, and we'll try to answer them as best we can. We're also recording the webinar, and we'll send everybody a link in the next few days. With that, I'm really excited to not be the one that's talking and bring you who you came to, Cerebral Tax Advisors. Now, she is with us today to share some insights into taxes for locum tenens physicians. Alexis is the daughter of a physician, and she's married to a physician, so this is a pretty personal thing to her, and she now gives tax advice to physicians. So I'm going to let her tell you a little bit more about herself, and let's get into the presentation. Alexis?
Great. Thank you so much, Mike. I really appreciate it. So as Mike mentioned, I grew up in a physician household. My father is a neurologist, and in the second week of college, I met my husband, and he is a neurosurgeon here in the Knoxville area. And basically, while he was going through, medical school and residency, and I was going through my training as my undergraduate is in accounting and finance, and then I have my MBA and my Master's of Science in Taxation as well. But basically, as we were kind of going through our lives and going through a lot of the same situations that a lot of my physician clients have gone through, I basically found that he was getting zero education when it comes to his personal finances as well as business finances. So he's in private practice, that really triggered me to start not only being a history recorder, which is basically preparing tax returns, but also to be very proactive with my taxes and with my clients' work as well, to find those tax strategies that the Warren Buffetts and the Bill Gates of the world basically use to obtain that 15% tax bracket. I mean, if they could do it, why can't I, for myself and my clients? So I really took a lot of time and skill in order to go and obtain these skills. And I created Gallati Professional Services in 2014, and I actually just rebranded this week to Cerebral Tax Advisors. And we're 100% virtual, so we work with clients all over the country. And we specialize in using a lot of video conferencing, just like this, and email, phone, and you have access to portal and everything. And basically, where I have a lot of experience is with situations that impact locum tenens physicians, and that has to do mostly with multi-state taxation and payroll issues associated with that, along with those advanced tax planning skills for someone who is an independent contractor. So Chad, if you want to go to the next slide. The most common questions that I receive as a tax advisor are what you see here. What type of entity should I be? How much should I put aside for taxes? What can I deduct? How should I be keeping my records? Which retirement account should I use? And any other ways to lower my taxes? So I really wanted to address a lot of these common questions I had in this webinar. So then that way you could get your most common questions asked, and then towards the end, we'll have some time for some Q&A as well. So let's get started and with which entity you should be looking at. So Jen. Great, thanks. There are 4 common types of entities. Now, most people, when they think like, oh, I'm starting a business, I need to be an LLC because the guy down the street is an LLC. Well, pump the brakes. That's not always going to be the best decision, especially being a physician. A lot of states have what they call a PLLC or a PC, which is a professional limited liability corporation or professional corporation. And this is because you guys have obviously a very special license, you know, your medical license, and the medical boards of those states kind of govern the entities that are set up. So, you know, I wanted to kind of discuss the taxation of each of these entities because each of them have a different impact. So when you're a sole proprietor or a single member LLC, the 100% of your profit is subject to self-employment tax. So that's Social Security and Medicare. And, you know, a lot of people, when they say, oh, I need to be an LLC because, you know, I can deduct things for my business. Well, even if you're sole proprietorship, you can still deduct the same expenses as an LLC. In some states, it's actually better to be a sole proprietor than an LLC. For example, in my state of Tennessee, the LLC ends up having an additional tax on it, and it's also more expensive to set up an LLC than just being a sole proprietor. So in general, if your income hasn't reached a certain level, there was really, or you don't have to worry about other liability reasons, then there's really no reason to, you know, go from a sole proprietorship to an LLC. Now, if you have, if you are worried about liability, then the LLC does help with that, although it doesn't necessarily protect you from negligence. So Nikolai, if you could just go and mute your audio. There you go. Thank you. So basically, the only time that you would really, first off, depending on which state you're in, you'll want to go and discuss liability issues with an attorney in your state, and especially to potentially attorneys that are familiar with states you're going to be working in. But in general, with the only time that you would want to have that LLC protection is if you have a partner, because you want to be protected from your LLC, from your partner's negligent actions. Again, I'm not an attorney, and this is just general advice that I give based off of my experience, but like I said, consult with an attorney. And so with a partnership, it's basically taxed the same way as a sole proprietor and single member LLC. It's 100% of the profit is taxed or subject to self-employment tax. And so you end up, you know, basically paying full into the Social Security and Medicare system. With an S Corp, what happens with that is you break up your income in between a W-2, so you have to pay yourself a reasonable salary, and which we'll talk about in a moment. And then the remainder amount is a distribution, and that distribution is not subject to self-employment tax. So that's where a lot of people see a significant savings is, you know, let's say you earn $100,000 and you pay yourself $20,000. Only that $20,000 is subject to the Social Security and Medicare tax, and the remaining $80,000 is, you know, basically not subject to that tax. So you can actually have quite significant tax savings with that. Depending on the state you're in, some states will tax those distributions and have, or they'll basically tax you as a corporation. So like, again, in Tennessee, any distributions are subject to the dividend and interest tax that we have here. So you know, there's no state income tax for individuals, which, by the way, for sole proprietorships, partnerships, and S Corps, they're pass-through entities. So they don't pay tax at the entity level, but it passes through to you as the individual. So it's basically tax, you know, on your personal tax return. And so with the S Corp, you just want to make sure that it makes sense for you, not only at the federal level, but the state level. And in general, I tell my clients, if, you know, if you're making around $100,000 or more, which most locums end up, having that sort of salary, then you probably want to start looking at the S Corp. However, I even have some clients that are making maybe like 40 to 50,000, and we set them up as S Corp, so then that way they can actually take a loss through retirement contributions. So basically, if you make a retirement contribution through your business and it lowers your income below zero, then if you're an sole proprietorship, single member LLC, or partnership, you can't take that loss. However, with the S Corp, you can. So that's another tax planning strategy that you want to end up taking a look at to see if the numbers basically work out. I was mentioning earlier about reasonable compensation. So a lot of people are like, oh, this is great. I'm going to have an S Corp, and I'm just going to make sure that I'm not going to pay myself a salary, and everything 100% won't be subject to the SE tax, to the Social Security and Medicare tax. But that doesn't fly with the IRS. If you're an S Corp, unless you are having a loss, a significant loss every year, you need to be on payroll. There has to be an extraordinary circumstance for you not to have that payroll being done. So it's very important to find out how much you're actually needing to make as a physician, as well as other jobs that you do in your business, like you're the janitor, you're the bookkeeper, you're the admin, you're basically the only, most of the time you're the only employee of the S Corp. So you have many hats that you're wearing as a business owner, and those all have different pay rates, hourly rates. And so you're not necessarily going to be having 80 hours at a physician's rate. Part of that's going to be at an admin rate as well, for example. So making sure that you're not overpaying yourself and being able to take advantage of having, a lower salary and getting more of that doing distributions is very important. One other thing I also like to point out, which we'll talk about a little bit more in a moment about health insurance, is depending on how you're being paid as depending on the entity you're in, health insurance is deductible in different areas. So I'll go over that a little bit more in a moment. Last but not least, you have the C Corp, which a lot of people, kind of discounted C Corps in the past, but now that it's at that flat 21% rate, it's really great, a great planning tool in order to kind of shift income over there and have it be taxed at the corporate rate. Now, when you actually take money out of the C Corp, you do have to pay a tax on it. It's a dividend tax. So it's about 15 to 20% dividend tax on that. So again, you have to run the numbers to see if it ends up making sense to do that. A lot of times I'll have clients that will not only have their locum work, but they'll also have like rentals and other investments going on that we can actually create a separate C Corp that will manage all of the rentals, for example, and then you can take advantage of a lot of other deductions that you can't take through the other entities, like writing off completely the health insurance or disability insurance, etc. So yeah, next slide. Okay, so let's talk about some of those deductions. Some of the items that, I'm sure most of you are familiar with are things like your mileage, your per diem, office in the home, health insurance, HSA, and then unreimbursed expenses, which is the big one. So with mileage, you end up, being able to take your actual expenses or the standard mileage. So the standard mileage for 2019 is 54.5 cents. And with that, that's the easiest thing to do. Basically, you just have to figure out what your total business mileage is for the year, and then you apply that rate, and that you don't have to keep any receipts for gas or new tires, maintenance, etc. So a lot of people like this because it has a lot less record keeping duties. However, the actual mileage can generally be a much better deal for you because you end up being able to write off a lot more. Like I was just mentioning, gas, tires, repairs and maintenance, insurance, any sort of lease payments as well, depreciation on the car. It can be quite significantly more. And it's just really important that you keep all those receipts. When it comes to tracking your mileage, I usually recommend an app called Mile IQ, and it's really great. Basically, I call it like the Tinder of of mileage apps. You just kind of swipe right or swipe left if it's business versus personal, and so it's important too that you record your mileage at the beginning of the year. So then that way you can, at the beginning of the year and then at the end of the year. So then that way you know what your total miles is. And then basically what you're doing is taking a percentage of the business miles, of the business miles over the total miles to get the amount that you're actually allowed to write off. Another major expense, especially for locums, is the per diem rates. So this is a set amount that the IRS puts out every year that says, depending on which city you're in, you will get X amount per night or per day, sorry, for your hotels and lodging, and for meals and incidentals. So I think this year for meals and incidentals, it's like $54 a day or something like that, 55 maybe. And what that basically is, what you want to do is follow or just make a really good record of where you've been. So like what city you've been in and what days that you were there. And there is a website, if you just Google per diem rates, it's a government website. I think it's gsa.gov, I believe. That basically, if you go there, you just say which state you're in and what city, and it'll pop up with what the per diem rate is for that city. And so it's this can be quite significant than actually going and keeping track of all of your, let's say for all your meal receipts, for example. And I know most of the time, like I'm not going to spend $50 a day on my meals. And that's usually the number one thing too, that most physicians aren't being covered by those hospitals. So that they're helping out at. Usually like the air and the hotel are covered, but meals and incidentals generally are not. And so having those, being able to keep track of those, it generally will end up being a much larger deduction for you than the actual expenses you take. Next is office in the home. So since you have your own business, you, in general, as long as you have a dedicated workspace in your home, you can take the business percentage of your home, which is basically the square footage of your business office, and over the total square footage of your house. And so that percentage, you're able to deduct things like your home utilities. So basically pretty much everything, water, gas, electric, your security system, if you have a security system on the home, any cleaning for the home, any repairs, and then, making sure too that you're keeping a division between what is kind of communal expenses like utilities versus direct expenses to your office. So let's say you repainted your office. Well, that's a direct expense. You can deduct that 100%. So, and other things that you can be deducting as well are things like office supplies and your equipment. So if you have a computer, even if you bought it in the past, you can, as long as you know the fair market value of the computer when you basically place it in service, you can go and write that off, the business percentage. So you'll want to go and kind of determine what that business percentage is. Generally, as long as it's reasonable, that's fine. Like cell phone, for example, and that's going a little bit into unreimbursed expenses. I personally use my cell phone, and I know my husband uses his cell phone like 90% of the time for business. So that's reasonable for someone in your profession, because basically you're on the road all the time. That's how people get a hold of you. So being able to write off your monthly expenses, as well as the expenses, the actual expense of the phone as well. So if you go out and buy a new phone, then writing that off. Next is health insurance. So there, for obvious reasons, you're self-employed, so you're going to have to be, unless you're getting it through a spouse, you're going to have to have your own health insurance. And this is depending on which sort of entity you're in. You can either deduct it within the entity, or it's deducted on your personal tax return. So in general, with like an S Corp, if the S Corp is paying those premiums, that's actually added back to your salary. And so you have to go and do a few things, to make sure that you're having everything lined up correctly to take that deduction through the business. Otherwise, you would just end up taking it on your personal return as an adjustment to your income when set up properly, as opposed to through your Schedule A as an itemized deduction, which is limited in the amount you can actually deduct. Next, the other thing you want to take a look at is an HSA. So if your health insurance is a high deductible plan, then you are most likely going to be eligible to have an HSA. So if you're not familiar with what those are health savings accounts, and they're really great. They're like triple tax advantage. So you're able to put away, you put the money in. So this year it's $7,000 tax-free. It comes out tax-free or grows tax-free, and then it comes out tax-free if you use it for medical purposes. Even if, let's say, you get to retirement and you have some in there and you don't need it for medical purposes, it basically kind of ends up being like another IRA. So you can take that money out, but you would have to end up paying tax on the amount you take out that you don't use for medical purposes. So I always highly recommend the client using that if they're able to, because a lot of HSAs as well, you're able to go and not only pay for medical expenses, but you're able to use a portion of it to invest as well. So it can grow much more rapidly than just being like in a money market. And then lastly, with these unreimbursed expenses, these are going to be the common things like, if you have any equipment, like I just talked about with the computer, but also any loops or anything else you use for your profession as being a physician, the licensing and board exam fees, conferences, any parking and tolls, the scrubs, lab coats, you just want to make sure with those that they're actually more considered uniforms as opposed to street clothes. So I have some clients that would, try to like, oh, I need a business suit because I need to go do interviews or those sort of things. That doesn't fly with the IRS, because you can wear that outside for any purpose. Where something like the scrubs or the lab coats, those are obviously very specific to your industry and are basically considered uniforms. The only thing that I have a little bit of leniency on are like the dance go shoes. A lot of my surgeons like to wear those because they're much more comfortable to wear and for longer periods of time while standing. And so that has a little bit more specific use to it. And so I'm more comfortable personally taking something like that. The website link on the bottom of this screen is really great, because basically it's from the IRS. It says, here are the things, the credits and deductions that individuals can take as a business owner. So that's a good place to start. And Also too, if you're interested in a Excel spreadsheet that kind of lists out a lot of the common expenses, and I'm consistently going and updating it, if you email me, and my email will be at the end of this, then I'm happy to share that with you. So Chad, you want next slide? Great, thanks. Okay, great. So you know what to deduct now. So how should you be keeping these records? Well, the IRS basically has about 3 years to audit your return. Now, there's some exceptions to that, like if you have gross fraud on your return, then that doesn't count. But assuming that you're all on the up and up, basically keep your records for a minimum of 3 years. But I prefer 7, just for me as a professional. I just think it's safer to keep those sort of things. If you're like other people in my family, like my father, for example, he's old school and he still has all of his tax returns. And so I'm paperless. I don't want to, that's a lot of trees to kill. So, but it's really important that you treat your business like a business. So the number one thing that the IRS is going to go and ding you on is if you commingle your personal funds and your business funds. So, if you're setting up an entity or just even being a sole proprietor, you want to have a separate bank account and a separate credit card account for all of your business expenses. If you are like a sole proprietorship or a single member LLC partnership, you'll just want to go and make sure that, basically anything that, if you need to get money out of your account, of your business account, you can just make a transfer, because as those entities, you're not allowed to be on payroll. So you just receive distribution. So that's really important too, because I have some clients that, they're a sole proprietor or a single member LLC, and they set up themselves up on payroll, and we had to backpedal and fix all that. It's also important to remember to save receipts, actual receipts, and because credit card statements do not fly with the IRS. They need to actually see what you purchased. So what I recommend doing, so then that way you don't have to keep all of your, these paper receipts in like a box. Just take a picture of it with your phone and save it to like Google Drive or one of those places, and they can easily go and organize everything. Going down a little bit to the record keeping, you can use things like QBO, which is QuickBooks Online, or Xero, which is an Australian company that's similar to QuickBooks Online, but I personally like QuickBooks Online better. And they're really great because they take your bank statements and download all the transactions, and they learn your transactions as you use it. And so then it becomes very easy to categorize everything, and you can take a picture and attach that receipt to that transaction. So there's a lot of really great ways to do that through there, as well as apps like Expensify, which as you're able to track those receipts, and then also track mileage as well. When it comes to if you're an S Corp or a C Corp and you're an employee and you need to get reimbursed for expenses, then you want to make sure to have an accountable plan set up. So basically what that is you have to submit a expense report to your business, to your S Corp or your C Corp, in order to be reimbursed back. And you have to also give the receipts. So the reasoning for that is, if you are just reimbursed, let's say a set amount per year, let's say $10,000 for all of your expenses from your business, then the IRS is going to consider that income and you have to pay tax on it. Versus just being completely reimbursed, you need to have an actual accountable plan set up. One thing that I do want to mention with working as locum, doing locum work, is you have to avoid going and working in the same geographical area for over 1 year. So like basically a 12-month period, because what the IRS will do is they'll consider that to be a more permanent location versus a temporary location. And so some of these expenses I've been mentioning aren't deductible then. So it, like the meals and incidentals, for example. So it's really important that if you are going to be going over a year, that you are aware of this rule, or you tell your tax advisor, so then that way they can make sure that everything is being reported on the up and up, and the IRS doesn't come back and try to ding you for those expenses. Yeah, so next slide. Okay, so another big question I have is, well, what about retirement? Which retirement account should I have? And the first one that I generally don't even recommend anymore to my clients is the SEP account, which is self-employed pension plan. And that is what you basically get to put away is approximately 20% of your profit, or 56,000, whichever is less. So right now for 2019, in order to achieve that, you need about $152,000 or $156,000 of profit or wages in order to meet that amount. A lot of people like it though, because it's basically free to set up and very easy to administer. I mean, you can just go online to like Fidelity and set it up online in like 20 minutes. It's very easy. So in some cases, I recommend it just because of the administrative hassles a lot less for clients. But most of the time, as locum physicians, you're earning quite a bit more. And I have clients that basically they're trying to just build that wealth and build that financial independence, and so they want to sock away as much money as possible and get that tax benefit as well, because it is a deduction. These are all pre-tax deductions, except for backdoor Roth, which we'll explain in a second. And so the one that I normally recommend the most is the solo 401k with profit sharing. And so there's an employee deferral of 19,000, and then an employer deferral of about 25% of your profit, or 37,000, whichever is less. So there's a $56,000 limit. They're generally inexpensive to administer, especially if you're all by yourself. If you have employees, that's another story. But if it's just you and your spouse, for example, it's very easy to administer. But there is a form you have to file once you get over 250,000. And then the next is the defined pension plans, which usually is a cash balance plan with a 401k profit sharing. And this is really great because you're able to actually put away a ton of money, depending on your age. And most of the time you're able to put away more than that $56,000 limit. They are definitely more expensive, and there's much more administrative hassle, but 99% of the time, the tax benefits outweigh the hassle, in my opinion. And so, and lastly, with the backdoor Roth, I'm sure a lot of you are familiar with, because most of you are going to be making over the $193,000 if you're married filing joint, or $122,000 if you're single. That limit, if you go over that amount, you're not able to make a direct contribution to your Roth account anymore. So you have to do a backdoor Roth, which basically is you're making in this case for 2019, you make the $6,000 contribution to your traditional IRA, and then you roll over immediately to your Roth IRA. And so what's really great about that is it's another avenue that you can do along with all the other retirement accounts I just mentioned that will go and allow you to go and put away more money, and into a Roth account, which is, if you're not familiar, traditional pre-tax accounts, you have to pay tax when it comes out. But with post-tax accounts, which is the Roth, you're taxed at the beginning when you put it in. One important thing with the backdoor Roth, you have to make sure that by the end, let's say if you want to do it for this year, that by the end of this year, you have to make sure not to have any traditional IRAs, SEPs, or simple accounts open in order to take advantage of it. And so that's another reason why I always usually recommend the 401k, so then that way my clients can take advantage of that backdoor Roth. Again, they're easy and inexpensive to set up and administer. Next slide. Thanks. So there, of course, a lot more strategies that are available to those that own a business. I mean, the tax code's made for those that own businesses. And so one of the main things is income shifting, which basically is taking income from your tax bracket down to a lower tax bracket. So with a child, and usually it's about, I recommend 7 years or older, there are tax court cases that basically verify that this is the best way to go. It's really great to shift some income down to them, and then you can actually be saving for retirement and saving for education and other lifestyle expenses like their tuition for their private school. And I normally recommend moving that money like into a Roth account, and you can use that for college later, and which I like better than the 529 plan, because if for some reason they don't need that 529 plan money because they got scholarships, a full ride, etc., then you don't have to pay tax on the money that comes from the 529 plan, because you have to pay for that tax. You have to sorry. If you have distributions from a 529 plan that are not for college or educational purposes, then you end up having to pay tax on that. With a Roth, that's not the case. So they can just keep holding on to it for however long they live. And what's great with hiring a spouse is that gives you the opportunity to actually put more away for their retirement as well. So it doesn't save you as much when it comes to actual like tax on your return, except for the fact that you're able to go and put more away for their retirement. Another great plan is medical reimbursement plans. I like these, especially with C Corps, where you can have not just your health insurance, but also any of your other out-of-pocket medical, co-pays and dental, vision expenses paid through the business. And so basically it avoids any sort of income limitations on your Schedule A. Next are tax advantage investments. And so these are things like conservation easements. The conservation easements are quite a complicated topic, which I could probably spend another hour just talking about those. But basically what it is, you are receiving, for your investment, you're receiving a charitable deduction of usually about, anywhere from 2 to 5 times your investment. So for example, my husband and I contributed to a land conservation easement where they were conserving land, and we contributed $50,000. We received a $230,000 tax deduction as a charitable deduction on our Schedule A. That saved us $80,000 in taxes. So net in $50,000 investment, it's about $30,000 tax savings. So they can have quite a significant impact on your return, but they are listed transactions, so they're more highly scrutinized by the IRS. Now, other sort of credits that you can buy, in Georgia, they have film industry credits. So they want to encourage people to come in or Hollywood to come in and make films there, et cetera. It has a pretty big film industry there. And so they allow taxpayers to actually buy credits that helps lower their Georgia taxes. In these other states, you can see that there's also primary care tax incentives and then rural care tax credits. So basically these states are providing physicians that work in those areas these tax credits for, like, for example, the rural care tax credit, it's for underserved areas. And so they're trying to get people to go in. So if you might want to keep these in mind, especially when you're looking at different jobs and traveling, that these might, pertain to your situation. Yeah, next slide. So lastly, I wanted to talk about the quarterly estimated tax payments. Obviously, this is a big question. And once you've gone and done your tax return and you've figured out what your tax liability is going to be, you can go and figure out what your quarterly payments need to be. So you have, so when you're W-2, the IRS says you have to pay the tax, on the income you earn as you earn it. As a W-2, that's done for you through your regular pay stub. However, as 1099, that's not happening, so you have to pay this on a quarterly basis. You either pay 100 or 110%, and if you're over $150,000, it's going to be 110% of the prior year tax, or 90% of your estimated current year tax. So that will keep you safe from underpayment penalties. You still might owe on your tax return, but those will keep you safe from underpayment penalties. So I always say, at least in the beginning of the year, to go and pay based off of your 110% of your prior year tax. So then usually in like September timeframe, then we start looking at where you're at for the year and how much you're making, and then to go and change those estimates for you. So then that way you're funding it, there's no surprises on your return, you know, what's you're gonna end up owing, but also to making sure that you are staying safe. So one other thing that you wanna look at is that not only for the IRS, but also the state. So if you are working in not only your own resident state, but also other states, you're gonna owe tax to those states. So it's really important that you are aware of, you know, the states you're in, what their tax rate is, and doing some sort of projections to see, you know, how much you're gonna be estimated to owe. If you haven't been in that state in the prior year, then you don't have to worry about your quarterly payments for that state. You're still gonna owe on your tax return, but for underpayment penalty purposes, they assume your rate was 0. So 110% of the prior year 0 is 0. And so it's whichever is less. So, you know, that's another thing too, is, you know, if you know you're going to be making a lot less money in 2020 versus 2019, then you'll want to go and do that 90% of current year tax and estimate how much you're making and how much your tax will potentially be. So that way you're not overpaying as well. What I highly recommend doing, instead of sending those vouchers with the check and, you know, just do your payments online. You can go to irs.gov and make those payments. They have right on that homepage, they have a make a payment. Believe me, they're going to make it nice and easy for you. And it's the same thing too with most states. If you want to email me, I have a list of all the states and where their payment sites are. So then that way you can go and make payments to the IRS, not only, you know, the quarterly payments, but also any other payments like your tax due as well, if you don't do it through your tax software. So yeah, why don't we go next slide? Oh, that was it. So, but yeah, basically, you know, when it comes to the locum work, the main things you have to really look out for is, you know, the different states that you're in. If you go and create an entity in your home state, but then you're working in other states, then you have to form qualify your business in those other states, which basically means you have to register your business in those states. And there's usually going to be some sort of other payroll obligations, etc. When it comes to payroll, just make sure that you're working with someone that treats you as a roaming employee, which basically means that you they'll be able to keep track of all the different states you're in, no matter when you get paid in the pay period. At this time, like the last time I checked, payroll providers like Gusto or Intuit Full Service Payroll, they don't offer that. You want to be looking at some of the bigger guides like ADP. I use Paychex, and those are the two main ones, ADP and Paychex. So just make sure that you're aware of that requirement as well. But yeah, so I hope that you guys found this useful, and I guess we'll go to some questions.
All right, thanks, Alexis, very much, very informative. We've been getting a lot of questions for you, so I'll kind of lob some at you. So first question that we've got is health insurance a deductible expense as a sole proprietor?
Yes. So what you'll end up doing is having it, it's an adjustment on your 1040. So basically below the total income line, or total gross income, I should say, and before you get to adjusted gross income, I believe it's line 29, you can go and take that as a deduction.
Great. Okay, another question. I have a single member PLLC. When I fill out a W-9 for people paying me, should I enter my social security number or EIN in the W-9? some entities want my social security number instead of my EIN. I thought since I'm doing business as my entity, I thought I had to enter EIN. What's your advice?
EIN, definitely. So as a locum, and even this is 1099 independent contractor, I should say, you're a single member PLC. If you're just a single member PLC, you can actually do either way. I personally like using the EIN if you have it, because in that way you're just not giving out your social security number. But if you're an S Corp, then you'll definitely want to use, or a C Corp, you definitely want to use that EIN, because the IRS does not allow you to nominee your income to your entity. So if you receive a 1099 that's in your social security number, you just can't put it onto your S Corp tax return, because basically it's just not allowed. So you'll have to go and change that to make sure that it is in the EIN of the business.
Okay, thanks. All right, another question. If a locums company, i.e. Weatherby, covers these expenses, travel, accommodations, then how would we benefit from deductions?
Well, like I said, most of the time, I mean, and correct me if I'm wrong, Mike, but does Weatherby go and reimburse for like meals and incidentals?
It depends. It's all in the relationship with the client. You were pretty correct when you said, the travel expenses, housing are typically in almost all scenarios reimbursed, or actually paid. And then meals are typically the physician's responsibility. In some cases, we have some latitude there.
Sure. So yeah, it depends on the contract that you have. But in general, meals and incidentals aren't usually covered. Definitely your office and your home is not covered. And then if you, like I said, depending on the contract, sometimes even your conferences, your licensing, those sort of things aren't covered as well. So those are all legitimate deductions that you can take.
Perfect. Okay, if I was a C Corp 2018 and I was expecting a 21% tax, however, my accountant said there's a limit for income above it, the tax bracket went back to 35%. So 35% plus. So again,
for a C Corp?
Yes, C Corp 2018.
Okay. I would have to get back to you on that, but from my understanding, it's a flat 21%.
Okay.
Even for professional service corporations.
All right. All right. I have health insurance through my spouse. Can I still take deductions if I pay her my share? Also, can I still keep contributing to my old HSA, which I had through my previous employer?
So no about paying her for part of your health insurance and taking deduction for it. That's unfortunately no. You're not allowed to take that self-employed insurance deduction if you are eligible to be on your spouse's health insurance plan. And then, what was the other one? The other question?
Yeah, the other question is also, can I still keep contributing to my old HSA, which I had through my previous employer?
It's my understanding, as long as you have a high deductible plan. So then you can. But I believe that I guess, is he saying that if you don't use them anymore, but you have your own high deductible plan now, can you still contribute to that one?
That's what I'm gathering.
Okay. I believe that you'd probably want to roll that over to a new HSA, in my opinion. So then that way you have more control over it, and you can actually choose the type of plan that you have it in. But I'd have to look further into that.
Okay. And then if you are in the same geographical area for more than 1 year, are miles deductible? I understand meals and incidentals don't count.
No, unfortunately.
Okay. We have a ton of questions coming through, and maybe what we'll do is in the essence of time is we'll take a couple of more. that I'll get to you, Alexis, and then knowing that Alexis is going to respond, and we'll get answers to the questions, and then we're also going to send out the link. All right, so we had a question. Let's just say that we've been doing locums, or I've been doing locums for 2 years, and after looking through this info, there are things you would like to change from the prior year. Is it possible to amend those returns with some of the more appropriate filing entities, such as a sole proprietorship versus an S corp?
Sometimes, yes. The problem with changing to an S corp for prior years is that you have to have been acting like an S corp. So most likely you have not been, doing payroll for yourself, for example, and so it's not really possible to do that. And you don't want to go and file like back payroll reports, because if I have one piece of advice for all of you, do not mess with payroll. Don't do it yourself. Make sure that you have someone else to do it, because payroll penalties are nothing to mess around with. It's brutal. And so in general, if you weren't acting like that entity and the requirements of that entity in those years, then it's my advice not to do that, and just try to do it from here going forward.
Great, thanks for that. Should we wait until the start of a new year to incorporate?
It depends. So in general, like this late in the year, I'm a little more inclined to wait until the beginning of the year, but it also depends on when you're making your money. So if you didn't make as much during the beginning of this year, but you're going to be making a lot more in this last quarter, then it makes sense to go and change over to be a new entity now, so then that way you can take advantage of those tax savings with that brand new entity. All right, so
oh, go ahead, sorry.
No, I was just gonna say, like most things in tax, it depends.
Yeah, there's a lot of, absolutely. So last question that I'm gonna ask you, Alexis, and thank you so much again. Can you deduct health insurance if the premium is Medicare Advantage plan?
I am not sure of that answer. I will get that answer for you though when we answer everyone back.
All right. Well, thank you. So you can see this is a topic that means a lot to a lot of people, and a topic that a lot of people have a lot of questions about. It's the number one, I'd say the number 1, 2, and 3 question that we get after we've kind of defined our locums arrangement with our providers is a lot of tax questions. So I'm very, very pleased and happy, Alexis, that you took the time out of your busy schedule to join us today and provide some of these answers. So again, final announcement: we will be trying to get to all the questions. We have a ton in the queue that we weren't able to answer today, but Alexis will work hard and get back to everybody. So thank you very much, everybody. Thank you, Alexis. Thank you, everybody, for took your time for this webinar, and expect that link. Thanks so much.
Thank you so much to Mike, Chad, and Elise and Kim. Thank you so much. Appreciate it.
Have a great day, everyone.
Bye-bye.